Welcome to the Canadian Investors Course, Session 17, Psychology, You and Your Advisor. Slide 2 contains the terms of use and disclaimer. Please review them. Make sure you match your advisor to what you want. Hopefully through this course you've learned about all the different instruments and investment styles available to investors. Choose what investment style is appropriate for you. Then match yourself with an advisor who can deliver that to you. Advisors have higher licensing, can have many investment styles, and a broader mandate. Don't let the advisor steer you to what they want to do or what they're restricted to. An IIROC advisor has access to almost every type of investment. It doesn't mean they use them all, though. There's nothing wrong with an IIROC advisor using one type of investment product. Maybe that's their style. Maybe it reflects their abilities. And not all advisors apply rules-based investing. It's a discipline and requires effort. But it's not extinct. You'll probably find one or more advisors in your community who are willing to make the extra effort to maintain this discipline. You can go to the locator on this site to find one if that's what you're looking for. You and your advisor. Well, like we've told you before, especially in Session 13, it's a good idea to create an investment policy statement. Maybe it's not going to be a formal one, but certainly it wants to cover fees and what you're going to invest in and your asset allocation model and all the relevant components and how often the advisor is going to be in contact with you. Don't be afraid to ask questions regarding the market or your portfolio. A good advisor loves an educated client and should be more than willing to help educate you. If they're not willing to do that or not interested in doing that, maybe that's a good indication that they're not the right advisor for you, if that's what you want. Look at the whole portfolio. If you only really want to discuss one stock that's down and complain about it, do you really understand the concept of owning a portfolio of holdings? It's very important to realize that sometimes just because a holding's down doesn't mean it's not got a good place in your portfolio. After all, part of the objective of the portfolio is that different components of it pick up slack at different times. So discuss this with your advisor and understand that even the Dow Jones, the Dow 30 has, its odd dog. And if you're calling your advisor to, every day, several times a day because you're watching the markets too closely, maybe you're not seeing the bigger picture. Also, it could be the relationship. Do you trust your advisor, or are you really concerned about what they're doing with your money? And don't be shy to ask your advisor about an investment idea. Some of an advisor's best ideas come from their clients. A good advisor will be happy to research your idea and come back to you and suggest to you why it's either a great idea and you should buy it, or perhaps why not. In fact, a good advisor spends a lot of time telling his clients not to buy things, and in fact has to temper their clients' emotions. At market extremes, that can be difficult. When the market's hot, people want to buy stuff, and maybe they shouldn't. And when the market's down and they don't want to buy things, maybe they should. A good advisor has plenty of research and tools to help them do this. You can take the CIC course. You've already taken it. Congratulations. But if you can look back on it anytime you want to refresh your memory on parts that you didn't get and maybe talk them over with your advisor. Remember that you always have a certain level of risk. If you demand to match the returns of the market, this may lead your advisor to buy the index itself. And perhaps that's going to keep you happy, especially in a bull market. But if the market turns down for a long period of time, becomes a bear market, it's also going to guarantee that you participate in that. And that might be something you'd prefer not to do. So again, talk to your advisor, figure out what's right for you and what you want to do. And remember also that selling into an expensive market is a sound policy and something that really makes sense over market cycles and helps avoid bear markets. So discuss this with your advisor, and if your advisor comes to you with some profit-taking ideas, pay attention and don't try and chase that last dollar, because chasing the last dollar sometimes means you don't get it and you don't keep some of the others that you should have kept too. Your advisor wants to make money for you. Don't forget that, especially in a fee-based account. In a fee-based account, doesn't the advisor make more money when you have more wealth? In other words, you have more assets. Don't they make more money? So clearly, your interests are aligned. So work together to see how you can make that work for you. And always be aware of your risk parameters. So let's look at investor philosophy. People in general buy high and sell low, and that's what you want to avoid doing. Online investing and the investment medium have caused more inexperienced investors to eventually fall into the buy high, sell low pattern. More trading's occurred because of this too, which has been good for the discount brokers. Investment advisor communities tried to go the other way. Now there's less and less individual stock trading going on in most advisors' clients. Most accounts are not commissioned, but they're fee-based. Humans get bold and irrational at market tops and scared and irrational at market bottoms. The bull market since 2009 has not been driven by large earnings growth. We saw that in the slides in the last segment. The bulk of the profit in stocks from the accounting has come from accounting adjustments and large increases in market multiples. So, for example, PE ratios have gone up and up. This creates huge emotional and irrational speculating. Investors are pouring billions every day into index ETFs, which benefit from this kind of market. This could present a problem when everyone tries to exit at once. I guess time will tell. Usually, a good discipline for buying investment forces you to do the opposite of the crowd. Markets hate holding cash at market tops and want to hold cash at market bottoms. What's that mean? Buy and hold philosophy is most popular in long rising markets and market tops. Buy and rule should be popular all the time. So let's look at the investor psychology cycle. So if we look at revenue growth as a percentage of total reported EPS, 2009 to present, there's been lots of accounting gimmicks, but if you look at the revenue growth, it's been pretty small. Now let's look at investor emotion. This is a classic slide. As the market's going up, the investor feels optimism, excitement, thrill, and euphoria, starts to pull down. And that's, of course, the point of maximum risk is at the euphoria point. Then comes the anxiety, denial, fear, depression, panic, capitulation, and despondency, which is where they should be buying, but that's where they're saying, geez, maybe the markets aren't for me, followed by desperation, relief, hope, and optimism as the cycle starts again. Don't forget, this cycle never goes away. A few investor sentiment indicators that measure philosophy. Well, the bullish percentage, in other words, advisors bullish versus advisors bearish. Clearly, when too many advisors are bullish, the market's getting oversold, overbought. They're too bullish, they're buying too many stocks. When everybody's too bearish, they're selling too many stocks. If you do the opposite, it tends to be a good philosophy. The fear and greed index, it's tied very much into that last slide. When people are feeling really good, they've got lots of greed. When they're feeling fearful, they've got lots of fear and they don't want to invest. Clearly, if they could do the opposite of what their emotions are telling them, they do well. Then there's the market volatility index, the VIX. This index shows huge complacency at this point. It's really low. Portfolio managers buy this investment as a hedge in case the stock market drops. Current level is lowest in history. And then there's the percentage of investors bullish to the bond market. Clearly, if people are bullish in the bond market, that indicates that they think interest rates are going to go lower, one would think. And it also indicates that they're concerned about stocks. So you buy bonds when yields are high and the sentiment is negative, and sell bonds when the yields are shrinking and the sentiment is positive. Then there's the McClellan Volume Summation Index. And the McClellan Volume Summation Index measures the advance and declining volume on the New York Stock Exchange. So when the advance decline line shows more stocks being sold, it means the market's getting bullish. When the advanced decline line is rising because more stocks are being bought than sold, that means the market's bullish. So bearish when it's negative, bullish when it's positive. Sometimes you must do something mechanical to help overcome emotions. So a good way to do that is to use these crosses. Look at the crosses that gave significant signals. Some weren't that important, but if you followed them all, it worked out okay. And imagine the news headlines at the time. Most like it was very bullish on a sell and very bearish on a buy. Look at October 1987. Stocks plunged 508 points, a drop of 22.6%, and the volume nearly doubles record. And that was a great buying opportunity, as history showed. Then let's look at the 20s and 30s, the Depression. So here's 29 and early 33 newspaper headlines after the slide. Below is what the cross indicated. The buy crosses in 32 led to a 160% gain at the time, and the sell cross that occurred by the time the next sell cross occurred in 1934, and the stock went up 300% from the 1932 low. And yet, if you'd have been a buy and hold investor, you'd have been underwater. (1929) Investors should have sold. The media, for the most part, reflects fear and greed in the general public. It's been a great contrarian investment signal at the extremes. In other words, invest opposite to what's recommended. There's a saying, the reason why newspapers are not expensive is because they report history. I'll pay much more if you can give me next week's paper today. Review the headlines below in your time and see what was said between 1920 and 1933. Remember, the stock market peaked in the fall of 29 and then fell 80% until late 32. The stock market went up 300% from the 1932 low to 1934. So 29 to 32 headlines. 29. No cause for worry. The high tide of prosperity will continue. That was Andrew Mellon, Secretary of the Treasury. And then Secretary Lamont and officials of the Commerce Department today denied rumors that a severe depression in business and industry was impending, which had been based on a mistaken interpretation of a review of industrial and credit conditions issued earlier in the day by the Federal Reserve Board. That was on October 14th, 29. Then October 29th came the market crash. And December 5th, 29. The government's business is in sound condition, said Andrew Mellon. And then December 28th, 29. Maintenance of a general high level of business in the United States during December was reviewed today by Robert P. Lamont, Secretary of Commerce, as an indication that American industry had reached a point where a break in the New York stock prices does not necessarily mean a national depression. And so on and so on. You can review these as you feel, as it amuses you. Anyway, March 12, 1933. Stock market comments by Joshua Kennan. We've talked about 1929 period a lot lately, but what you need to remember is that it was a walk in the park compared to 1933. It wasn't until then that everyone had gone broke, given up hope, and sworn off stocks for life, leaving great businesses trading at double-digit dividend yields and a fraction of book value. The crash of 29 was but a blip. The depths of 1933 were like a nuclear bomb going off and leaving nothing but wasteland. Before we get into this, we've already established that the stock prices in 29 were absurdly high. No rational human being could have possibly acquired ownership stakes on those terms and thought to do well, with the typical issue trading at 30 times earnings, representing starting earnings yield of roughly half the yield that should have been attained by acquiring a long-term United States Treasury bond at the time. Buying the nation's largest bank for 150 times earnings is not a particularly intelligent thing to do when it should be trading at 10 times earnings in a rationally priced world. Still, it's interesting to see how someone who bought in at the top of the market did, acquiring shares at the very apex of the speculation bacchanalia that overflew from Wall Street into Main Street, or vice versa, depending on how you look at it. It was the bursting of this bubble that caused stocks to become an absolute steal, but most people were starving to death, waiting in breadlines. Feeding your family was a higher priority than buying blue chip yielding more than 10%. How does that sound compared to today? Anyway, if you've got any questions, call Jerry Gabon or go to the website and look for a trusted wealth professional. Thank you for listening. This is the end of the course. The Session 17 commentary is accompanied by music.